hope you guys find this interesting. This is going to be an introduction to risk management in trading, so the basic principles. And mainly we'll be defining risk management and talking about the importance of risk management in trading. Now, the types of risk we face, obviously the main one is market risk. This is the risk we have when we're trading. Basically, when you open a position, let's say you buy a specific asset or you sell an asset, and you want it to go in your direction to make money. And the risk you have, of course, is that it goes in the opposite direction and you lose money. So this is the first risk we face, and clearly the most obvious, because you can make money trading, but the offside to making money in trading is that you have a risk of losing money. So the first and principal risk is market risk. But then there are also, let's say, slightly lesser risks, but always relevant. And they are liquidity risk, credit risk, and legal and regulatory risk. Let's look at liquidity risk to start with. Liquidity risk, there are two main types of liquidity risk. Let's start with what is liquidity. Liquidity is the capability of a financial market to supply prices. If you want to trade a financial market, you must have prices, or prices must be available to the trader. So if you want to buy an asset, you have to have somebody willing to sell it. And if you want to sell an asset, you have to have somebody willing to buy an asset. This supply of prices is called liquidity. And liquidity risk comes from the fact that in certain markets or in certain moments of a certain market, there may be very little liquidity or no liquidity at all. So what can happen? If usually a market is quoted, the bid and the offer is quoted, and because you're seeing the prices in the market, you can trade on that asset. Yeah, somebody's quoting a bid and somebody else is quoting an offer. And if whether you want to buy or sell, you can open a position and trade on that asset because the financial market is liquid in that moment. But there are times where this phenomenon disappears. One liquidity risk arises when economic data is released, especially in the United States. Very important economic data, such as non-farm payrolls, or inflation data, or gross domestic product data. These are very important macroeconomic parameters, and the financial markets pay a lot of attention to them. So what can happen over the release during the first minute or two of a release of this type of economic data is that prices change very rapidly with no consistency in the trading. So you might find, for example, if you open a position 1 minute before non-farm payrolls is released, you might find that immediately after, on the release of the economic data, the price has moved a very large distance. So you might put on a trade, let's say you put on a trade in euro dollar, and your risk is $200. So you put a stop loss at $200 from your entry price. And in a normal market condition, if the market goes against you, pretty much you'll lose $200 when the level is reached and the stop loss is triggered, and more or less you'll lose $200. But around economic data releases, you might find that even though you had your stop loss placed automatically to exit your trade with a loss of $200, because of a lack of liquidity, the next price may be $400 away. So effectively, your stop loss is triggered, but the first available price was $400 away and not $200 away. So that is what we know, what we call is liquidity risk. Basically, you weren't able to exit your trade at the predetermined stop loss because of a lack of liquidity, which arises due to factors such as economic data releases, especially the most important one. And then there's also another type of liquidity risk, which comes from what we call exotic markets. Exotic markets might be an emerging markets, Brazil, Mexico, South Africa, where the liquidity is not very high. There aren't many people showing their bids and their offers and creating liquidity. Other types of markets that are also may lack liquidity are micro stocks. Micro stocks, these are very small stocks, maybe of only a few million of market capital. And that means that in any specific moment, you might want to be buying a particular micro stock, and you see a price on the screen, let's say it's 50 cents or 60 cents a share. But when you go and try and buy those shares, maybe you wanted to buy 1,000 of those shares, but you only get 100. And then the next price is at 75 cents or higher. And this is due to, again, lack of liquidity. So when we're trading, we also have to be aware, even if you're trading highly liquid markets, such as the US stock exchange or the euro dollar in foreign exchange, you have to be aware of the moments where liquidity can disappear all of a sudden. And also in specific, more exotic markets, you also have to be aware that there may be a higher liquidity risk, because simply there aren't enough players in the market to supply all the prices needed. Then we have credit risk. Credit risk is often not really something retail traders think about, but it's actually quite important, because when you open a brokerage account to trade, you're placing your cash with a third party. And this third party may be very reliable, very solvent, or it may simply be a scam. And because we have so many platforms which operate solely online, it's very easy to fall into a scam. Simply, you'll pay this platform your money, and at some point they disappear. And the way to solve this type of risk, counterparty risk, let's say, is to use brokers that are regulated by a top-tier authority, preferably in more than one region. Regulatory authorities give plenty of oversight, and they require the brokers to commit to maintaining a certain amount of capital of free cash. And they also require the brokers to segregate clients' accounts. And segregation of accounts is very important, because it means your money, your trading money, is not held by the broker. The broker places it in a bank of its choosing, but it cannot access your cash. Neither can the creditors of the broker. If the broker were to go bankrupt, your money is segregated in other accounts that do not belong to the broker. So the creditors of the broker would not be able to access that money. So it's important to understand that you should never open an account with a broker that is not regulated by at least one top-tier authority, and preferably in more than one region, because it creates a lot of oversight, and there's very little or much less risk of something bad happening to your hard-earned cash. And then the last one, the legal and regulatory risk. let's say this is a smaller risk, but depending on your region, depending on where you live, you may or may not be able to trade some types of assets or some types of financial instruments. For an example, in the United States, US residents are not allowed to trade CFDs, the famous contracts for differences. And you also need to know whether you have to pay taxes on your winnings. Some countries tax profits in trading, other countries don't. That's also a factor to bear in mind, let's say, although perhaps it's not exactly crucial, but it's worth having those things in the back of your mind as well. Don't want to fall into the bad books of the tax man. Okay, and let's look at the next slide. So, the key principles of risk management and trading. I think the first foundation in risk management is understanding risk and reward. Clearly, you don't want to risk more than what you may make as a profit. If we use investing as a parody, for example, somebody offers you an investment of where you have to invest $1,000, and they're going to, with all likelihood, they say you'll make 10% a year for the next X years. That might sound very appropriate and might have might seem appealing as an investor, but you must also consider, or you should also be considering, what is the risk if this investment loses. Because if then the people proposing this investment tell you, well, you have a risk of losing 20% a year, then this investment doesn't look so appealing anymore, because your gain is 10% a year, and you risk losing 20%, you risk losing double what you could gain. That clearly doesn't have the same appeal as a 10% investment with, let's say, no risk, zero risk, yeah, to amplify the difference. So in trading, we have the same understanding of risk and reward. So if you're looking to trade and your stop loss is because of your trading strategy, as I've mentioned in other classes, the trading strategy defines where your stop loss is going to be. And you see a viable trade, and you see that the stop loss is, let's say, $200. Well, what would your target profit be on that trade? Is your target profit only $100? Because if your target profit is only $100, but your stop loss should be at $200 before you understand if the trade was wrong, it's not a trade worth putting on. Yeah, those type of trades should be avoided. You want to look for trades where your stop loss is 200 and your target profit is more than 200, preferably 300 or 400. So that as long as you're making more winning trades than losing trades, you'll be making money on your account, because each winning trade covers the losses and there's more left over for you to keep as profits. And this comes to the next stepping stone of understanding risk management, and that's the win ratio. And win ratio, a lot of people place a lot of importance on the win ratio, and there are some traders that can manage 80% or 90% or very, very high percentages. But the thing about the win ratio is that it's not enough to have simply a high win ratio if, as we understand in the first point, your risk is higher than your reward. If you have a very high win ratio, but every time you enter a trade, your risk reward ratio is 200 loss and 100 profit, that's not going to make you a lot of money, because you're losing a lot more than you're winning on the trades, on your losing trades. And that brings us to the next step, the average profit to loss. This is the average profit and the average loss. Your average profit should be simply higher than your average loss. So if you take all your trades, you sum the profits in your winning trades and you divide it by the number of trades, and you do the same for losses, the average profits should be higher and considerably higher than your losses. So these first three steps are about understanding your win ratio, which may not be sufficient to have a very high win ratio if your risk reward is not appropriate. Okay. And the other factor is diversification. This comes from investing as well. In investing, we'll know we shouldn't put all our eggs in one basket. When we need to diversify our investments, so a proper portfolio will have some real estate, we'll have some precious metals, we'll have bonds, we'll have stocks. The stocks themselves will be diversified by industry and sector, and so on. Now, this is the same in trading, because if you're going to trade Forex, for example, and you take a position in euro-dollar, and then you decide to take a position in sterling dollar, basically you're taking the same position twice. So your risk is not diversified. Your risk is exactly the same. If you buy euro-dollar and you buy sterling dollar, you're simply amplifying your risk because of correlation. Correlation means that two different assets move in the same direction most of the time. And you know from statistics that the euro-dollar and the sterling dollar will move in the same direction around 80–85% of the time. So if you want to diversify your trading, perhaps you want to do euro-dollar and something completely different, for example, gold, where gold and euro-dollar have very little to no correlation. So if you take one position in euro-dollar and you take another in gold, they are uncorrelated and your risks are diversified. Yeah. Okay, any questions so far?
To ask questions, you can write questions into chat or raise your hand. To raise your hand, you go down to reactions, click on reactions, and you'll see a little button that says raise hand.
Okay, let's continue then with the,
okay. Oh, we have a hand raised.
Okay, yes, go ahead.
Au revoir, Capomo. Oh, try that again.
Are you doing it?
Yeah, are we both doing it?
Yeah.
Okay.
I guess that's what
Okay. Thank you. I think not really a question. I can barely hear Gino, but this presentation looks very detailed and technical. I would appreciate if it could be sent now. It's so nice. It's sweet to hear, but I'm struggling to hear. But Gino is very, very meticulous about this presentation, and it's quite interesting, but I'm struggling to hear. And I will appreciate if it could be sent to us immediately, please. So if you can make some essay out of it. Thank you.
Gino D'Alessio, are you able to upload the presentation into chat?
I believe I sent it. Yeah, I can upload. How do I do that? Let me see.
Into chat, you'll see like you'll see a couple of images at the below where you write your chat message, and one says file.
File, there you go. Okay.
And you click on that and you'll be able to upload a file.
On my computer, okay.
Yes, this is technical.
Yes.
And but once you learn these terms and you're aware of these terms, you will reduce your risk. Correct.
There's a lot of terminology. If I don't know how many of the students have been following my previous classes, but if they go and watch the previous classes, they'll probably understand this one better.
Yeah, the previous classes, you've gone through trends, technical analysis, and being able to really see a trend going off into the future and know when there's risk.
Yeah,
But now you're getting into the more detailed aspects of what types of risk there are and how to deal with them.
that's correct. Because risk management at the end of the day is to understand your risk and to apply to open trades where your risk is going to be smaller than your potential profit. So basically, in other words, if your potential profit is $200, you want to open a trade, you want to open that trade if the potential loss or your maximum loss is a lot less than 200, at least 150 and preferably $100 of loss. And this is something I mentioned in one of the previous classes. You'll put your trading strategy, when we did the how to build a trading strategy class, through your rules that you preset. You can establish, you have to be able to establish where the profit, where the stop loss would go if you entered that trade. If the stop loss is too big, too large compared to your potential profit, then the trade is not viable. And your own rules will determine that because the stop loss is larger than the potential profit, that trade will not be taken. That should be established as part of your rules. Right, let's to the next slide. So I mentioned before the effect of the average profit and the average loss. We see these are three tables. Each table has the same win ratio, 0.6 or 60%. So that meaning that 60% of trades are making money, and the other 40% are clearly losing money. Let's start with the first table on the left. We see that the average profit on trades is $50, but the average loss is $100. Now, despite the win ratio of 60%, which actually is not bad at all for a retail trader, we see that this account, after 100 trades, would have lost $1,000. And we can calculate that very easily, but the easiest way I find is to multiply the average profit by the win ratio and add it to the average loss multiplied by the loss ratio. That will give you an average profit loss of minus $10. So you have an average profit loss of minus $10 over any number of trades, 100, 200, etc. So let's say you did 100 trades, you multiply it by 10, you'll get 1,000, minus $1,000. Yeah. Now, if you consider the same win ratio, the middle table, where we have a 60% win ratio again, but the average profit is $100 and the average loss is also $100. And at this point, you would make over 100 trades, you would make $2,000. So already by maintaining an equal average profit and average loss, your trading results improve dramatically. So you go from minus 10 to a plus 20 profit per trade.
Gino, can you check the there's a message in chat from Andrew Joseph where he's wanting to confirm a formula. The win ratio means is equal to the number of wins divided by the number of attempts.
Yeah.
Is that correct?
Win ratio is simply the number of trades that win. Let's say you put up 100 trades, 60 of them were winners. That means your win ratio is 0.6 or 60%. Does that answer the question? I can't see the chat. Oh, here it is.
Yes, that does answer the question.
Yes, it does, right? Yeah, okay, now I see it. Okay. So going on to the third table, always maintaining, are there people with their hands up who want to, okay, I'll let you guys ask me a question in a second. Just let me finish this last table. We have a win ratio of 0.6 again, but we have an average profit of $120. against an average loss of $100. And now our profit and loss average, our profit and loss, our trading account after 100 trades would be up by $3,200. So we can see that by maintaining a higher average profit, we are going to greatly improve our results. Okay, I'll let Agos wants to ask a question. Go ahead, Agos.
Okay, thank you so much.
Thank you.
Can you hear me? Can you hear me?
Yes. Yes, I can hear you.
All right, thank you. Thank you for the presentation. My question was with the diversification of the trading.
Yeah.
I was not following up very clearly. Maybe I need some clarification on that diversification trading. Thank you.
Sure. So basically what I was trying to show, I'm going to share another screen, just 1 second. I was trying to show was the correlation between similar assets or similar financial markets. So here we have the price of gold, and just now I can't see my screen because I have a lot of stuff in the way. Okay. Right. So if we look at so we look at another scheme. Right. And here we look at if we look at this is sterling dollar, and we look at euro dollar, and we can see a very similar chart, even better on the day chart. Right. So we see very similar picture between the two forex markets. This is sterling dollar, and this is euro dollar. Okay, they're very similar because the fundamentals between both of these currencies, the sterling and the euro, are very similar. Obviously, there are moments when they don't trade in the same direction, but generally, and we know this from statistics, 85% of the time, between 80 and 85% of the time, sterling dollar and euro dollar will move pretty much in the same direction. So if I put a trade on euro dollar, let's say I decide to sell it here, and I sell, let's say I've got an account where I can sell up to 2 lots. And I say, okay, I'll sell 1 lot in euro dollar, and then I'm going to sell another lot in British pound to diversify my risk. Well, the truth is you're not really diversifying your risk because of the very high correlation between the euro dollar and the sterling dollar. So your risk is pretty much 2 lots short, 1 in sterling euro and 1 in euro dollar. You haven't diversified your risk. Meaning you could have chosen to sell 2 lots of sterling or 2 lots of euro. The risk is pretty much the same. The way to diversify would be to say, okay, I sell, this looks like it's going down. I'm going to sell euro dollar, 1 lot. I can trade another lot. I'm going to look at gold. Okay, and from what I see in gold, day chart on, from what I see in gold, this looks like it's going down again. I'm going to sell gold. Now these two trades are uncorrelated because we know from statistics again that the price of gold and the price of euro dollar are not very highly correlated. I believe it's around 0.2 or 0.15. So we'll tend to see that these two financial markets do not move in the same direction so often. So that here you are diversifying your risk. Does that make it clearer? In fact, you can see with this chart how, compared to the euro, for example, how this has been going up while this was coming down. Yeah, there's a lot less correlation between these two financial markets. Does that answer your question, Agos? Okay, we'll presume it has. Right. So now the next part is about risk management strategies. Okay, somebody else, before I get started on that, somebody else raised their hand. Go ahead. I don't know what format.
Just, oh wait, it's easier. It's not clear to me.
Sorry?
The explanation is not clear to me.
The correlation?
The explanation is not clear to me. The answer is not clear to me.
Right. Let's go back to the, what are you? Right, let's go back to,
What was it, the euro? The euro and
Yeah.
sterling?
yeah, I'm just trying to get my screen back up.
Okay, because I see we're on the price of gold now.
Yeah,
Mhm.
right. So, well, what I was trying to put across
Yeah.
is that when the price of gold, for example, goes up, it's not necessarily the case that the price of the euro dollar will go up also. Yeah. And in the same
And
way,
so that means there's an element of risk there. I mean,
Yeah.
if gold went up and the euro went up, there would be no risk if you wanted to be certain of that.
right. So what I'm saying is that in the sterling, yeah, in the sterling and the dollar, sorry, in the sterling and the euro, if we look at, and it's harder to look further back, but if we look at the past 2 weeks, let me highlight that. We look at this part here look at that on euro, and now we look at the same period on sterling. Obviously, the proportions are slightly different because of the way the chart is. Let me see if I expand the chart. Okay, maybe that looks similar now. If we look at euro dollar and we look at sterling dollar, we see that the price action is practically the same. And correlation tells us how often this similar price action happens. Yeah, from statistics, we can see that sterling and euro against the dollar move in the same direction around 80% of the time, between 80 and 85% of the time.
So I might just say here, when you do a correlation, you look at the dates and you look at the prices for each through time, and then you can do, like if you're in Excel and you put those data into Excel, you can just do a quick correlation function.
That's right.
To get a measure of that correlation.
Correct. Right. So we know that these two markets are highly correlated. So if you have, let's say you have 2 lots, you can trade 2 lots. If you sell 1 lot of euro dollar and one lot of sterling dollar, basically your risk is 2 lots in the same, more or less in the same direction, because these markets are extremely similar. Whereas if you trade the euro or the sterling with 1 lot and then you put on another trade in gold, because the markets are not correlated, your risk is diversified. You're not actually trading 2 lots with the same risk. Gold has a different risk to the euro or the sterling because gold doesn't move in the same direction as euro and sterling with any great frequency. So you're diversifying your risk. Yeah, I don't know if that helps.
I
I
saw
guess-
your line. You were so busy. I don't know whether you were in a mosque or something. After I called you, I called John Aluya. John Aluya responded, and he told me that I should call you, that your presentation was very fine. I should try and call you. I called, your line was busy.
And somebody needs to turn off the unmute it. Unmute it. Okay. So let's get back to let's go back to the slides. Right, so we saw that by increasing the average profit, by increasing it above the average loss, you get a big improvement in your trading performance. And what we were about to talk to was the strategies in risk management when you're trading. Possibly the most important thing is setting a stop loss. And stop losses have to be set, have to be a hard stop loss, we call them. Well, what we mean by a hard stop loss is that when you place your order, you also place an order to exit the trade when it loses X amount of money. So if your stop loss is $100, you enter the trade, you open the trade, and you also place a stop loss, automatic stop loss that will tell the broker to exit your trade if your trade is losing $100 or more, and it will happen automatically, right? That's called a hard stop loss. Some traders, especially in the older days when automation wasn't so easily accessible, stop losses were placed on a piece of paper. They would write down the stop loss on a piece of paper. But the problem with human psychology is that when you see the price going against you, you don't want to be wrong, you want to be right. So you scratch out what you wrote on your piece of paper and you write down another number for your stop loss, a larger number. And what tends to happen is that most of the times you will simply lose more and more money until eventually you'll get fed up and you close it at a much higher loss than you would have lost if you had respected your stop loss. So stop losses have to be implemented automatically when you open a trade. Because of your trading strategy, you already know where your stop loss is going to be and how much money it is. So you open the trade and you place an automatic stop loss so that the broker exits your trade as soon as that loss is reached. However, in the same way, but in the opposite direction, you should also be placing take profits or target profits. And placing the take profit helps you lock in your potential profit. When you set up your trade, because of the rules in your trading strategy, you can also define where your potential profit is going to be, and it should be somewhere close to it, not above it, if anything a bit less, to guarantee that you'll get some profits. And this ensures that once the market moves, and perhaps it moves very quickly, your profit is taken. And if it continues moving up, well, that's another story. That's another trade to be considered. But the trade that you set up automatically took its profits when it reached the target. That's also a very important factor that often traders will move it around. Like it goes very close to their profit target. And they say, okay, this might be going up a bit further. I think I'm going to move my profit for a larger profit. And that never materializes. In the end, they take a smaller profit or they lose money. So it's very important to once you've established your rules, to respect them and automate the stop loss and automate the take profit. Then there's another, this is going into a bit more detail, let's say. You can also move your take profit once your trade is profitable. For example, let's say you put on a trade with, let's talk in pips, because you see, or maybe it's easy to talk dollars. I think let's talk dollars. Put on a trade with a stop loss of $100 and with a target profit of $200. The trade goes in your direction. It goes up. You now have $100 of profit. Or what you could do to guarantee that that trade doesn't become a losing trade is move your stop loss. Yeah, move your stop loss to a positive stop loss. So now instead of your stop loss being at minus $100, you could put it at plus 50. So if the market comes back down, the worst that will happen is that you will make $50, but you won't end up losing any money. I don't know if that's clear. Anybody want to ask any questions about that?
I do not see any questions.
No. Okay. So let's go ahead. So so the stop loss and the take profit always has to be in line with implementing the risk reward ratios. Well, as we mentioned before in the previous slides, the risk reward ratio and your average profit to loss ratio are very important because they will help improve your trading performance. As we saw in the previous slide, having a 60% win rate, which is very good, but having a poor average profit compared to your average loss is going to make you lose money. So it's very important to keep at least your average profit at the same level as your average win, at least, and if not, to improve it, to have a higher average profit than average loss. And lastly, risk management also entails using leverage wisely. Why do we need to use leverage wisely? We need to use leverage wisely because if we use too much leverage, we can blow our account, blow it completely within 2 or 3 trades, right? And again, we touched leverage and what leverage was in previous classes. And so let's look at some examples of leverage, 5-to-1 leverage in the top row. Excuse me. So 5-to-1 leverage means that I can trade with 5 times the amount of money I have on my account. So if I have a capital of $1,000, I can trade with $5,000. This is my 5-to-1 leverage. But let's beware that $5,000 in Forex, for example, which is an easy market to understand, 10 pips, which is not very much, is equal to $5. So if I'm trading, if I'm a scalper, let's say we mentioned the scalper, swinger, and we mentioned all that as well in the first lesson, I believe. If I'm trading to make 20 pips, well, I'll make $10, and my stop loss should be at 10 pips, while I'll lose $5. If I'm looking to make or lose $10 or $20, yeah, 5,000 is fine. If I also consider my initial capital of 1,000, if I'm making or losing $10 or $20, that's not going to be a hardship for me. If I do 2 trades and they both lose, and I lose $20 or $30, well, it's not too bad compared to my $1,000. Yeah. Now, if I use a lot of leverage and I increase my leverage to 20-to-1, now I can trade $20,000. Yeah, my initial capital is 1,000. I apply a 20-to-1 leverage. There are plenty of brokers that apply 20-to-1 and 30-to-1 and 40-to-1, and much higher, as we're going to see. Well, I can trade $20,000, but 10 pips and now is $20. And like I said, 10 pips in Forex and with 20-to-1 leverage in any market, you're risking a lot of money, basically. And because of Forex markets don't have a lot of volatility, it's around 1%, 1.5% a day. Yeah, you can perhaps get away with 20-to-1 leverage, but you know that 10 pips, which is nothing in the Forex market, is $20. I'm just gonna, somebody's written something in the chat.
Yes, there are actually two questions in chat.
Right.
Which one are you reading?
I was looking at one from Onyai Paul.
Yes, that's basically saying, it looks like it's saying, you look at the business strengths and weaknesses, scanning their environment for significant opportunities.
Hmm.
So it seems like he's saying that the best way to reduce your risk is to know the business that you're investing in.
Yeah. But this is more, what you're talking about, Paul, is more about stock investing. So obviously investors in the stock market need to understand what they're investing in. I believe there are various big investors like Warren Buffett and Peter Lynch who have many times said, I don't invest in anything that I don't understand. And that I agree with. In the same way, you shouldn't be trading in any market that you don't understand. So it should be clear to you what Forex market is about, what it represents, and any market you decide to trade in, you should understand the market, understand what the financial market is actually there for, whether it's futures or options, or you should understand the financial markets. And here the references.
Gino, if I can just, I think what you're saying is, you can look at the business, but the business has to deal with the Forex markets and that those external factors which affect its price.
Right.
Is that what you're saying? Is that you really have to pay attention to those external factors beyond the business?
Yeah, Paul's comment is about investing in stocks because, like he says, you have to analyze the competitors, creating goals, objectives, formulating strategic options, translating strategic plan into action, establishing accurate controls of business. Question: can't the above help in business journey to reduce the risk in any business and strategic management? Yeah, well, these things can, but obviously it's rather off topic because this is more about stock investing, and this is more about trading and investing. We could do a class at some point on that. The difference between investing and trading.
Oh, that would be good.
Yeah, I believe there's a lot of ground to be covered there. But yeah, let's go to the next question. Is trade pairs of products in their entirety advisable? Should just a mere singular choice?
So basically, do you when you invest, should you pick 2 or 3 to invest in, or just 1 at a time?
It's trading pairs. I believe this is Shakiri Matos. I believe you're talking about what I mentioned before. You're trading euro dollar and sterling dollar. My advice is, if you're going to trade Forex, it's better to choose one Forex pair, especially if you're looking at highly correlated Forex pairs. Choose one and trade with the amount of capital you want to allocate to that trading, to trade that one pair. Because if you trade sterling and euro, you're just doubling your position. You're not diversifying your risk. So if you wanted to diversify your risk in trading, you would have to look at uncorrelated markets, for example, gold and euro dollar. Okay, so let's continue with what I was saying. So here,
by the way, there's 8 minutes left.
8 minutes left, right? So basically, right. So we saw the basic takeaway here on the leverage is that the higher the leverage, the greater the risk. And obviously you can make a lot of money. In the last row, you have 100-to-1 leverage, and you'll be trading $100,000 with your $1,000. But every 10 pips is $100. We look at this slide here. We can see that in any one day, there's 100 pips difference between the open and the close. That would wipe out your account in one day if you're on the wrong side. So it's a very dangerous scenario to be using 100-to-1 leverage. Closing comments. The biggest mistakes in trading when we refer to risk management. One of the most common I find, and I've done it myself, is overtrading. What happens with overtrading? or you make a trade, you lose. Okay, I'm not happy about that. I'm going to put on another one. You put on another one, you lose that trade as well. Now you're really angry. Now I'm going to start trading. I'm going to put on another trade, and you keep looking for trades, and you put on another one, and you put on another one, because you've let your emotions take control of you. And we all hate being wrong. We all hate losing money. And so you start over trading. Now that only makes things worse, because then your whole trading plan goes to hell, and you only end up losing more and more money. The consequences of this overtrading usually lead to neglecting the scenario analysis. And what do I mean by that? I mean, you've set up your rules to analyze the financial markets, and you've got a series of parameters or technical indicators that you're going to look at to help you determine the direction of a financial market. When you start overtrading, you'll be neglecting all that analysis. You will simply be neglecting, because you'll be wanting to see something to trade on. And the last one, which is what I was mentioning earlier, is ignoring the correlation of risk. Right. So if you want to trade different financial markets to diversify your risk, you need to trade really different financial markets. You can't trade euro, dollar, and sterling dollar, because they're very similar and they move in the same direction very often. So maybe you want to trade gold and oil, crude oil, or crude oil and euro Swiss foreign exchange, but not to trade financial markets that are highly correlated if your objective is to diversify your risk when you're trading. Okay, I think we've all done. Any questions? Any questions for anyone?
There's just Agos wants to verify, what does it mean, a leverage from 100 to 1?
A leverage from 100 to 1, right?
So that's basically, if you're gonna put $1 into the trade, you're actually purchasing $100 worth of value.
That's correct, yes. So you multiply your trading capital by 100.
So with $1, you can buy $100 worth of something.
That's correct, yeah. But it doesn't happen in the stock market, okay? Because if
No,
you're going to trade the stock market, that's a completely different matter. But
it seems in the past that the stock market, like in the 1920s, got into trouble when the leverages were like 33 to 1, 50 to 1.
Yeah, a lot of borrowed money. But nowadays, the best leverage you'll get in the stock market, I believe, is 2 to 1. So you can trade twice the amount of capital you have. But these leverages ratios, they apply to any type of forex broker. Not all regions will allow you to trade with 100 to 1, but some do. And most
that still exists.
Yeah,
it's hard to believe that still exists.
Yeah, it still exists. I can't believe people are mad enough to trade with 100 to 1.
Yeah.
But even 20 to 1 is very high. You have to be very, very precise in your entry and exit, and be very, very careful and how exactly. Yeah.
I always thought that the limit should be 16 to 1. Anything below that you can work with, but anything beyond 16 to 1 gets dangerous.
I go by what the hedge funds do. Hedge funds are professional traders, and there's basically no hedge fund that trades over 10 to 1 leverage.
Yeah.
So I suggest that leverage should be limited to 10 to 1. If you can trade successfully with 10 to 1 leverage, you're going to make a lot of money. There's no doubt about it. And okay, so somebody wanted to ask a question here, and Anjola's gone.
Gone. Let's go to Lumbayi.
Hi. Good morning.
Oh,
good morning.
Hello.
Anjola. Hello, Anjola.
Hello, sir. Good to see you.
Good to see you too.
I would like to ask, so in terms of the trading market, what would be your specifications for advising an incubator sector? So what incubator?
Sorry, I can't understand. What did you say?
What would you advise an incubator in terms of the market?
What would I advise in the market?
An incubator for the trading market.
Yeah, but
So I think he's saying if there's a business being incubated,
I understand. Yeah,
yeah. So
I don't.
go ahead.
I don't know of any businesses that are being incubated in the trading market. So I don't know what to advise there.
So a business that's being incubated has to find its money in a different way. It just can't sell stocks on the market.
Right. Yeah, no, indeed. Usually these types of companies go to fundraising, crowdfunding, I believe it's called crowdfunding platforms.
Angel investors.
Yeah,
things like
angel investors, crowdfunding platforms. A couple of crowdfunding platforms is republic.com, thefunded.com, I believe is also another one. That's where startups and all these type of entrepreneurs go. Right, next one, Lumbai.
Thank you.
You're welcome. Thank you.
Thank you, sir. Take care.
Thank you. Lumbai, I think Lumbai was next, right?
Hello, Dr. Leopard. Hello, Gino.
Hello, Lumbai.
Yes. Gino, I love your presentation. It's so
Thank you.
good. But one thing that I like to ask you. So, you know, we, like myself, I never studied this kind of things. Will you please clarify a little bit to us whereby we stack like those like ratios and those kind of things so that we can have more understanding in that. I don't know if you can help us with that.
Help you with understanding the ratios, or which part
The
exactly?
ratio, yeah, the averages, all those kind of things. So that is gonna be having, yeah, just kind of things like that.
Right. Right. Yeah. What we're talking about here is the win ratio, which means the number of wins out of 100 trades. So if you put on 100 trades and you win 60 of them, you get a win ratio of 0.6 or 60%.
Okay.
Okay. And the average profit is all the profits of all your profitable trades divided by the number of trades. That's the average, right? So in this case, it was only $50. And the average losses is all the losing trades, or the sum of all the losing trades divided by the number of losing trades. In this case, it was $100. Okay, this would give an average profit and loss of minus $10. Okay, despite the high win ratio. So if I traded 100 trades with this average, I would lose $1,000.
Oh, okay.
Yeah, despite having a high win ratio, because my average profit is too low. So we have to look for trades. We have to look for trades where at least my profit potential is equal to my maximum stop loss, which is, yeah, these two have to be at least the same. Okay, in this case, in this scenario, if I trade 100 trades, I would make around 2,000 because I have an average profit loss of $20 a trade. In the third table, I still have 60% win rate, but now my average profit is higher than my average loss. So now if I trade 100 trades, I'm going to make 2,200, and that's a lot higher than even the previous one where the average profit was equal to the average loss. This is because my average profit is higher than my average loss. So we have to try and aim for potential profits that are higher than the amount of money I have to risk to enter the trade. Yeah.
Yeah. Yes. Yeah.
Okay.
Oh yeah. Thank you so much for that.
Okay, you're welcome. Thank you.
You're welcome.
Right, and the next one is Liu. Liu. I don't know if I'm muted. Aliu? No, let's try again. I'm trying to unmute you, Aliu. It doesn't work.
Yeah. Yeah.
Oh, it worked.
Good
Okay.
afternoon here. Good afternoon. Good afternoon.
Good afternoon.
Dr. Lambert and Prof. Gino. I'm just seeking for clarification. It's a very interesting lecture that you are giving when it comes to, understanding what is meant by trading and things like that. And I want to understand why someone would go to the extent of investing or trading 100:1.
Yes.
Knowing that there is very risky, and then what is the motivating factor behind that? And having a lot of capital, and then you just want to invest so low, and you know that definitely there is a little gain. What the benefits definitely would be very low.
Yes.
Investing in such kinds of markets. Yes. So what are the motivating factors, or the motivating factors in investing too low?
Right. Right. Well, the motivating factor in investing with a lower leverage is that you have more control over your possible losses. Because your possible losses are, let's say, easy to manage, because if you're trading a $1,000 account with 5,000, but you're trading 5,000 in reality. Yeah. If you lose 20 pips, 30 pips, you lose $10, $15. It's not going to affect your capital too much. Yeah.
Okay.
If you trade $100,000 and you lose 30 pips, now you lost $300 in just one trade, and now your capital is down to 700. That hurts. Yeah. You can also make 300, but the problem is what happens when you lose 300.
300. Okay.
And that is the motivating factor why you don't want to use 100:1 leverage. For me, in my understanding, brokers offer 100:1 leverage because you're going to lose the money, and it doesn't matter to them. It's to entice or to attract people. They think they're going to make a lot of money because look, with 30 pips, I make $300. Oh, I want to do this. Yeah, but you can also lose $300. Right.
So is it that the broker now here, is it to the broker's interest to to entice somebody to invest or to trade at 100:1?
Yes, that's correct. So the brokers offer 100:1. So the people with little knowledge, not knowledge in general, but little understanding of risk. Yeah. Because they don't understand risk completely. They think this is a good idea, so they do it. But then the next thing they know is they are $1,000 is now $200.
Okay. Thank you.
You're welcome. Thank you.
Well, I think that's going to do it. Here's just one more question, I think, from Jeanette. Dr. Gino, am I still protected if the investment provider or my advisor goes out of business? Oh, you're muted. I don't know if you're talking.
I'm muting myself. Can you guys hear me now, right?
Yes, we didn't hear anything before.
Yeah, I don't know what happened there. Okay. Yeah, so I guess you're talking about the brokers, and when you trade, you usually use a broker rather than an investment provider. But yes, if this is what we were talking about before, credit risk. Credit risk is your counterparty risk. Your counterparty is your broker, because you trade with him. Yeah, the broker then trades with the market, but you actually trade with the broker, meaning you put your money with the broker. You send him the money and he keeps it. But if he's regulated by top tier authority, there's a lot of oversight, a lot of things he has to do, a lot of requirements he has to stick to. And this makes the whole process a lot safer, especially because all regulated brokers, when they're regulated by a top-tier authority, they're obliged to segregate client accounts. So your money is not available to the broker. Even if the broker goes bankrupt, because that money is in a segregated account, the creditors of the broker cannot get your money. Yeah, I guess that should clear it up.
And then you're at liberty to end your trade at any time.
Where's that?
So even if your broker goes out of business, you can still manage your trade.
No, if it goes out of business, the trade will be closed.
Oh, okay.
Because
And then
it's
the
not
money just goes back to you, whatever the closing price is.
Yeah, look, whatever the closing price, that money goes back to you.
Okay, I think that's going to do it. We've gone over a couple of minutes, but I don't see anything more. So next time you would be talking about, what would you like to talk about next time?
Well, I think the difference between investing and trading, or
Yes,
I don't know if
I think that's really good, because that's the
Yeah.
distinction that would be really important for people to, you know,
Yeah,
to be able to categorize, okay, this is trading, this is investing.
yeah. I think it's because I see a lot of confusion between the two terminologies, and they're very, very different.
The most important thing is to get familiar with these terms: market risk, liquidity risk, credit risk, like you see on your screen.
Right.
And to learn to understand these and where to recognize them and
Right.
how to measure them when you're looking at the data.
That's correct. Yeah. Yeah, indeed. Well, I hope you guys have learned something. I know this has been recorded, right? So probably
Yes.
re-listening to it will probably help understand things a bit better.
Yes. Okay. I think that'll
right.
do it. Thank you so much,
Okay, thank
Gino
you, everyone.
D'Alessio.
Thank you, Dr. Lambert.
And we'll see you next time. You're free
See
to
you
go.
soon. Thank you very much.
And I will stay on if anybody has questions about courses, anything
Okay.
academic.
Thank you very much,
All right.
guys. Take care, everyone.
Bye-bye, Gino D'Alessio.
Bye now.